Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to the Path to Recovery webinar. We are pleased to inform you that Capital Trust Securities was ranked number 1 for the calendar year 2021 in terms of transaction turnover, brokerage turnover, and number of transactions. Capital Trust Securities was also ranked number 1 for the financial year 2021-2022 in terms of transaction turnover, brokerage turnover, and number of transactions. Today's webinar is the 30th of a continuous series of webinars. Capital Trust Research Private Limited has been at the forefront in correctly identifying early and recommending stocks through its webinars and comprehensive research reports. Now, I'm pleased to introduce Mr. Hasitha Liyanage, Head of Research of Capital Trust Research Private Limited, who will make the presentation. Mrs. Divya Kasichetty is not available with us today, but would join with us at the next webinar. Thank you very much. Over to you, Hasitha.
Thank you, Prashani, for the introduction. Good morning, everyone. Sri Lanka is currently going through unprecedented economic, financial, social, and political turmoil. With a shortage of medicine, fuel, gas, power, and high inflation leading to an increase in cost of living, the general public have come out to the streets requesting a change in political leadership. However, there is a strong possibility of a caretaker government in the near future, which will drive positive sentiment in the market, similar to the 6% increase in the index when 42 members of the ruling party stopped pledging support to the government. Since the CBSL floated the Sri Lankan rupee on the 7th of March 2022, the LKR has significantly depreciated 67% against the USD by the 22nd of April 2022. We have, for the last 18 months, been promoting dollar income and dollar asset companies expecting the same. Some argue that the USD should not have been floated without substantial dollar reserves. The LKR is expected to depreciate further due to the acute scarcity of dollars in the banking systems and importers requiring dollars to settle LCs that were open previously. The government is currently in discussions with multilateral agencies such as IMF, World Bank, and ADB, and friendly nations such as India, China, and Japan for funding solutions that will bolster foreign exchange reserves and bring in exchange rate stability. As a result of the depreciation of the currency, prices of essentials such as fuel, gas, medicine, food items have increased significantly, thereby increasing inflation. The NCPI in March 2022 was recorded at 21.5%. Inflation is expected to increase further in April to circa 25% as the exchange rate depreciation accelerated and fuel prices increased significantly. In order to curb inflation and slow down the economy, and then rebuild, the new governor took the decision to increase policy rates by 700 basis points to 13.5% and 14.5% respectively, after the monetary policy review on the 8th of April 2022. This took investors and analysts by surprise, as it is the complete opposite of the policy followed by the previous central bank governor, which most investors and analysts were relying on to base their forecasts. As a result, the one-year Treasury bill rate increased by 767 basis points to 24.36% as of the 20th April 2022. This translates to a 19.98% interest rate after the applicable 18% income tax. Given the CBSL's decision to only accept T-bills below 25% at the recent auction, the central bank has given clear indication that rates will only be increased further if inflation picks up. As a result, T-bill yields plummeted 2 to 3% on the 21st April in the secondary market. So it can be expected that the current rates hold until April inflation figures are published in May. given the central bank has not announced a treasury bond auction so far, there is a possibility that they expect high interest rate environment to only continue in the short term. As a result, we expect nominal interest rates to be in line with the increase in inflation. The real interest rates was negative 5.83% net of taxes as at 6 April 2022. Going forward, we expect real interest rates net of tax to be near zero, and investors who are not satisfied with zero real interest rates after 18% tax would continue to invest in select stocks. As we will discuss in more detail late in the presentation, we expect the CSE to follow a similar trend to markets such as Argentina and Zimbabwe that defaulted its debt obligations. In these markets, the index initially pulled back sharply due to accelerated depreciation of the currency, high inflation, high taxes, high interest rates, social unrest due to the shortages of essentials, and thereafter it recorded very strong sustained gains. As you will see in markets such as in Argentina and Zimbabwe, after the initial sell-off in the equity markets and consolidation, the indexes far outperformed fixed income, even when interest rates reached an all-time high. So even when investors initially move away from equities to fixed income due to the increase in nominal interest rates, when they realize real interest rates are near zero, they are likely to look at alternative asset classes for capital retention in USD terms. It is evident that the investors in global markets that go through similar turmoil as Sri Lanka use the equity market to protect themselves from currency depreciation, rising inflation, and near zero real interest rates. As discussed in Sri Lanka, it is most likely that the currency will continue to depreciate in the short to medium term, as Sri Lanka is a net importer with an expanding trade deficit. Even though nominal interest rates will continue to rise, it will increase such that real interest rates are near zero. As such, in the medium term, equities are expected to outperform currency depreciation and inflation, thus providing an asset class that will enable capital retention in USD terms, given the extremely low forward PERs. As you can see, Sri Lanka's economic environment has changed drastically since the index closed at an all-time high on the 19th of January 2022. The index has pulled back 39.57% to date since the 19th of January 2022. The market PE has come down 46.4% to a PER of 8.05 times, which is one of the lowest in the last decade. Meanwhile, the exchange rate was floated on the 7th of March 2022, has depreciated a staggering 72.67%. In order to combat the inflation created from the LKR depreciation, CBSL increased policy rates by 850 basis points. By following market-based pricing for T-bills, the one-year T-bill rate has increased 1,488 basis points to 23.36%. As it was the case historically, FD rates haven't tracked the T-bill rate as banks don't increase the rates as much to manage profit margins. As such, the one-year fixed deposit rate at Bank of Ceylon was only increased by 600 basis points and is at 15% and 12.3% net of tax, which may not be enough to attract funds from the CSC, as the CCPI was 18.7% in March and the NCPI was 20.5%, whereas actual inflation is estimated at over 50%. As you can observe in the graph, the index has come off a staggering 21%, mainly based on the negative sentiment associated with the persistent power cuts and fears associated with the unavailability of essentials such as medicine, fuel, gas, power, due to low forex reserves. Since the currency was floated on the 8th of March 2022, the index has experienced significant decline of 24%. For example, the index dipped 11% from the 22nd of March 2022 till the 30th March 2022 due to political instability and protests due to shortage of essentials. On the 1st April 2022, the index decreased by 9%, mainly due to the violent protests at Mirihana. From the 4th to the 5th of April 2022, the index rallied 6% due to the resignation of the CBSL governor and the hope of political reforms, with 42 MPs crossing over from the SLPP. The index dipped 7% from the 5th to the 8th of April 2022 in anticipation of large increase in policy rates and the one-year T-bill increasing by 341 basis points. Looking at the previous two slides, we can summarize the reason for the volatility in the index as follows. Due to fears of default of debt, the index decreased by 8%. But since then, the government has announced a preemptive debt default, and the market has now priced this in. From the 19th January till the 1st of April, the index decreased by 16% due to extended power cuts enforced by the CEB, due to fears of business continuity and low productivity. But with monsoon rains starting early this year, reservoirs have filled up 50% already due to the recent rains, and hydropower accounts for 30% of daily power generation at present. As a result, the requirement for fuel for power generation will ease. In addition, the government recently unloaded 2 coal shipments that will ensure the availability of coal until September 2022. As a result, power cuts have been reduced from 13 hours to 3 hours per day. Therefore, a 16% reduction in the index is unwarranted and the market could recover. Due to shortage of basic essentials such as fuel and gas, the index decreased 6%. But with the government in the process of securing funds from friendly nations and efficient distribution of fuel, shortages might ease in due course, and if so, the market could recover. Due to the non-availability of basic essentials and increasing cost of living, citizens took to the streets demanding political change. This caused certain amount of political instability and social unrest, resulting in violence. As a result, the index decreased by 23%. But when there was hope of political reforms and change, the market gained 6%. Hence, most part of this has been factored in. As mentioned in our introduction, there is a possibility of a caretaker government in the near future, with many parties obtaining cabinet portfolios. This should drive positive sentiment in the market, similar to the 6% increase in the index when 42 members of the ruling party stopped pledging support to the government. In such an event, the market should recover the losses incurred. The new CBSL governor, Dr. Nandlal Veerasinghe, was appointed on the 7th of April 2022. The governor mentioned that it wouldn't be prudent to restructure local debt due to systemic impact on the domestic financial system, whereas foreign currency denominated debt has to be restructured to ensure debt sustainability. It was also mentioned that the CBSL will not intervene in forex and interest rate mechanisms and will allow market forces to determine both. Sri Lanka is expected to seek a bailout of USD 4 billion from the IMF, which is subject to implementing fiscal Sri Lanka is expected to seek a bailout of USD 4 billion from the IMF, which is subject to implementing fiscal and monetary reforms for the restoration of debt sustainability. As a first step, the CBSL called for RFPs for advisors to manage its debt restructuring exercise, which closed on the 22nd of April 2022. An advisor is expected to be appointed Sri Lanka is expected to seek a bailout of $4 billion from the IMF, which is subject to implementing fiscal and monetary reforms for the restoration of debt sustainability. As the first step, the CBSL called for RFPs for advisors to manage its debt restructuring exercise, which closed on the 22nd of April 2022. An advisor is expected to be appointed in the next 2 weeks. This will ensure a reduction in the country's debt to GDP and restoration of debt sustainability. Sri Lanka have already taken the following steps to initiate its debt sustainability program. The Central Bank of Sri Lanka removed its hard peg and floated the LKR to rely on market forces determining the equilibrium value of the currency. It moved away from the low interest rate environment and let the market forces determine interest rates as well. Real interest rates, which were negative, are now near zero, in line with IMF requirements. Removal of fuel and gas subsidies to ensure state-owned enterprises such as CPC and Litro are profitable standalone entities was also implemented. In order to qualify for IMF funding, the government has expressed that they will take the following steps as well. As per the Finance Minister, fiscal reforms will be implemented to increase tax collections from 8.6% of GDP to 13 to 14% of GDP. It is expected that tariffs and pricing followed by state-owned enterprises such as CEB and the Sri Lanka Transportation Board will be set using pre-agreed pricing formulas to ensure all SOEs are profitable standalone entities and not subsidized. Debt restructuring exercise to be carried out after the appointment of advisors is also a measure to be taken. If the reforms above are implemented, the IMF seems positive towards granting an extended fund facility. The finance minister stated that Sri Lanka will need external assistance in the form of bridge financing amounting to $3 billion within the next 6 months to help with supply of essentials. We expect IMF to provide financing amounting to $300 million within the next 2 months, and the balance $2.7 billion to $3.7 billion to be dispersed before the end of August 2022. World Bank has agreed to provide funding of $10 million for pharmaceuticals. Sri Lanka will seek a further $500 million to provide fertilizer and seeds to support the local agriculture industry. As per the statement made by the Indian Finance Minister, India will provide support both in the form of direct funding and also canvass at a board level at IMF to ensure a facility can be obtained from the IMF. India is expected to provide another credit line of $500 million for fuel and to commit up to another $2 billion in financial assistance, in addition to the existing credit lines of $1.5 billion. China has been requested for a credit facility of $2.5 billion to assist Sri Lanka, although further details on breakdown of the utilization of funds were not disclosed. The government is expected to seek assistance from the Asian Development Bank and its bilateral partner countries, such as the United States, United Kingdom, and the Middle East. These measures should ensure an end to social unrest due to non-availability of basic essentials and ensure business continuity when such facilities materialize in the next few months and will strengthen the market. The Monetary Board of the CBSL decided on several key policy responses to contain demand pull inflation, support stabilization of exchange rate, and correct anomalies in the interest rates. As a result, the policy rates, such as the standing deposit facility rate and the standing lending facility rate, was increased by 700 basis points each to 13.5% and 14.5% respectively. It is important to note that given the unprecedented economic state of the country, CBSL implemented the steepest rate increases to date. Tight monetary policy stance is expected to manage inflation driven by the build-up of aggregate demand, domestic supply disruptions, exchange rate depreciation, and the elevated prices of commodities globally. However, we believe Sri Lanka has mainly cost-push inflation, and therefore inflation will continue to rise in the short term. Therefore, stocks would be the best protection against rising inflation. It is also important to note the countries that have experienced debt default, nominal interest rates have been high and in line with high inflation, but equity markets have still outperformed fixed income securities. As discussed before, CBSL has now indicated that they would like to maintain T-bill rates at near 25% unless inflation picks up significantly. If CBSL is successful in maintaining interest rates at these levels, and then rates ease in the medium term due to easing of inflation and stabilization of the currency, it is expected that the CSC may pick up similar to what unfolded in Argentina and Zimbabwe markets. The devaluation is expected to encourage remittance flows, a major source of foreign exchange, through official channels. In addition, we expect Sri Lanka expatriates with USD to invest in the CSC as market prices have decreased 67% in USD terms. As the official reserves are insufficient to defend the currency at present, in addition to government's decision to opt for a preemptive default, there is a possibility of the LKR depreciation significantly in the short term until inflows are received from multilateral and bilateral partners. We predict a possibility of the LKR depreciating to LKR 400 per US dollar by the 31st of July 2022. As seen in the graph, when the Sri Lankan government and the LTT agreed on a ceasefire in 2001, and the IMF dispersed multiple facilities to achieve economic growth and poverty alleviation, the ASPI positively reacted, increasing significantly over the same period. Again, after cessation of the civil war in May 2009, the IMF dispersed an USD 2.6 billion standby facility that provided economic stability and enabled economic growth. As a result, the ASPI increased by 176% due to the financial stability and expected economic growth. The final $1.5 billion extended fund facility obtained from the IMF during the Yaha parliamentary period did not result in significant movement in the ASPI index, as can be seen in this graph. As mentioned earlier, the current economic environment we are experiencing is unprecedented, where the level of currency depreciation and inflation are very high. In order to combat inflation, CBSL opted for the highest ever increase in policy rates. Due to the extremely low forex reserves, there are shortages of essentials such as medicine, fuel, and electricity. In addition, due to the above, the depreciation has caused cost of living to increase to unimaginable levels. Although this is a new phenomenon for us Sri Lankans, other countries such as Argentina and Zimbabwe have experienced similar situations. Thus, we feel it's appropriate to take cue from how such equity markets reacted to such turmoil and what were the outcomes in the medium and long term in such markets. Just to give you a brief on Argentina, in 2018, Argentina faced many economic challenges, including economic contraction and high inflation caused by severe devaluation of the Argentine peso. Similar to Sri Lanka, the Argentinian crisis was caused by high, unsustainable build-up of foreign debt, tight currency controls since 2011, creating a parallel shadow market for foreign exchange currency. In September 2018, the IMF approved a loan of $57.1 billion to Argentina. Similar to Sri Lanka, the uncertainty of sovereign default following dollar outflows resulted in tight control on all currency exchange operations. As a result, Argentina was unable to pay back the 2018 IMF facility given the years of recession worsened by the pandemic, high inflation, and capital flight. As a result, Argentina's currency depreciated 74% against the USD in 30th March 2020 to 8 April 2022. Inflation was high at 48.4% in March 2020 and increased further to 52.3% in March 2022. On the 17th of March 2022, Argentina's Senate voted to approve a $45 billion debt restructuring deal with IMF. This lays out a fresh schedule of financing to be drawn down over a 30-month period to replace the failed program from 2018. As you can see in the graph, due to the economic turmoil caused by the high level of depreciation, social unrest, political turmoil, high inflation, and the impact due to COVID, the Argentine stock market initially declined 29%. But once the investors exited the market and overly margin positions were sold, the market moved in an upward direction. The currency depreciated 63% and the index gained 214%, even after accounting for over 20% decline in the index due to fears of default on the 2018 IMF loan. In the initial period where Argentina floated its currency due to the IMF conditions, inflation increased to 57.3%. During the period, the index increased a marginal 1%. During the period of June 2019 to November 2020, inflation peaked and then decreased to its lowest. Inflation decreased from 57.3% to 35.8%, and the index gained 61% during that period. December 2020 to January 2022, between reaching another debt restructuring deal with IMF, inflation increased from 35.8% to 50.7%, as the economy was by then used to high inflation and wanted protection against such depreciation and inflation via the equity markets. As such, the index gained 67%. Due to the increase in inflation and the IMF insisting on positive real interest rates, the Argentinian central bank increased policy rates from 65% to 83.26% over a period of September 2018 to August 2019. This resulted in a 26% dip in the index. September 2019 to October 2020, inflation peaked and then decreased to its lowest, as explained previously. As a result, policy rates decreased from 83.26% to 36%. With the interest rates dipping, the index gained 84%. In November 2020 to January 2022, the time period between reaching a debt restructuring deal with IMF, monetary policy rates increased from 36% to 40%. But as inflation was much higher, the negative real interest environment persisted, resulting in the index gaining 101%. Moving on to Zimbabwe, due to excessive money printing and poor economic management, inflation increased significantly in 2007 to 2008 as large sums of money was printed by the state. In 2016, Zimbabwe paid off 15 years worth of arrears to the IMF. In 2016, the government also agreed to major reforms, including public sector wage cuts, farm subsidy cuts, improving transparency in the mining sector, and reaching an agreement on compensating farmers. In February 2019, fears of hyperinflation returned due to the liberalization of the foreign currency market, through discarding the fixed 1-to-1 exchange rate peg between the USD. Due to the rapid devaluation, annual inflation increased to 176% in June 2019, before increasing to 761% in July 2020. During the period of financial turmoil between 10th April 2019 to August 4, 2020, due to the liberalization of the forex market, the index gained 1,266%, while the currency depreciated 2,395%. When the stock market resumed trading after a month, when the government shut down the index over allegations that the activity was undermining the currency, the index gained 600% when currency depreciation was only 30% during the period, spanning across 4th August 2020 to 18 November 2021, thus providing investors protection against currency depreciation in the medium term. During the period after liberalization of the forex market until the market was shut down, the index gained 1,139%, whilst inflation only increased 56.9% to 838%, thus providing investors protection against inflation. When the stock market resumed trading a month after the government abruptly shut down the bourse, the index increased 533% as inflation decreased to 54.5% from the highs of 838%. During the period after liberalization of the forex market until the market was shut down, the index gained 671%, whilst real interest rates were negative and moved from minus 303.3% to minus 726%. Once trading resumed, the index gained 781%, despite real interest rates turning positive at 5.5%. Similar to Sri Lanka, Pakistan has been facing challenges with currency devaluation, high inflation, a current account deficit, decrease in foreign reserves, low productivity, and dependence on imports, and repeated balance of payment crisis situations. Pakistan and the IMF signed a USD 6 billion deal in July 2019 for a period of 39 months, but the program derailed in January 2020 and restored briefly in March 2021, before again going off track in June 2021. On the 3rd of February 2022, the IMF approved a USD 1 billion loan, reviving a bailout package that has been suspended due to a delay in Islamabad's compliance with the terms. The $1 billion disbursement is part of the $6 billion bailout package signed in July 2019. The IMF had pledged to provide support under the Extended Fund Facility Program when Pakistan's economy was in a critical stage and needed assistance to meet the balance of payment challenges. Inflation was at a 2-year high of 13% in January 2022, and the currency hit an all-time low in April 2022, with Prime Minister Imran Khan being ousted following a vote of no confidence on the 10th of April 2022. On 3rd July 2019, IMF approved a $6 billion bailout package as mentioned before, but the Karachi All-Share Index didn't react positively to the news due to negative sentiment and foreign funds exiting the market due to Indian aggression along the eastern borders of the country. Despite the IMF facility, due to the Indian-Pakistan conflict, the index dipped 14%, while the currency depreciated 2%. After the index lost 7.1% in August 2019 due to the conflict, the market rallied 40% due to the easing of tensions and financial stability arising from the IMF facility and reforms. In addition, to the currency appreciated 2%. Due to COVID fears and funds moving from risky assets to risk-free assets, the index dipped 33% during the period of Jan to March 2020, while the currency depreciated by 9%. during the period from April 2020, when the market bounced back after COVID fears eased, to the 22nd of November 2021, when the market entered into a staff level agreement with the IMF to complete the sixth review under the $6 billion facility, the market gained 56%, while the currency appreciated by 4%. After IMF approved the $6 billion bailout package on the 3rd July 2019, inflation increased from 8.4% to 14.6% due to currency depreciation and market-based pricing on fuel. Equity markets acted as a hedge in such an instance and rallied and provided investors protection against inflation. After the IMF approved the bailout package on the 3rd of July 2019, Pakistan failed to increase policy rates fast enough, resulting in real interest rates decreasing from 5.76% to a negative 3.24%. In such an environment, equity markets appreciated 40% until COVID fears resulted in a significant dip in the equity markets globally. Moving on to Peru. Peru underwent the worst economic contraction in 30 years, led by the COVID-19 pandemic, where the economy shrunk by 40% year-on-year in April 2020 during the lockdown imposed. On the 28th of May 2020, IMF approved a 2-year arrangement for an amount of $11 billion under the flexible credit line designed for crisis prevention. As you can see in the graph, the Peruvian index declined 27% due to COVID. But as equity markets recover globally post-COVID, the S&P Lima index recovered too. But when the IMF approved a 2-year arrangement for $11 billion, the index gained 47%, while the currency depreciated 6%. During the period of 28 May 2020 till the 26th February 2021, the Peruvian Central Bank managed its inflation targets with the inflation below 3%. The index appreciated 47% due to the economic stability arising from the IMF facility. After the IMF approved the 11 billion facility for crisis prevention, the index gained 53% despite the 10-year bond yields increasing marginally from 3.83% to 4.19% and real interest rates turning positive. As displayed above, Argentina and Zimbabwe witnessed their stock market indexes recording strong gains in the medium term during periods of accelerated depreciation and high inflation caused by default. Across markets, stock indexes rose significantly as real interest rates were negative or turned near zero. This reaffirms investor confidence in equities and select equities, providing a good hedge against currency depreciation and inflation in the medium term. As discussed previously and as shown in global markets that have experienced what Sri Lanka is currently going through, markets recover in the medium term after a short period of strong sell-offs and consolidation. Going by what occurred in other markets in similar circumstances, the current sell-off experienced in the CSE seems quite extreme. But given that there is still more forced selling to be carried out by margin trading providers such as NBFIs and banks, we can expect further downside before the market recovers. Going by examples such as Zimbabwe and Argentina that went through similar cycles, equity markets should provide protection against both currency depreciation and inflation in the medium term. So investors that seize the opportunity and enters at near bottoms or remains in selected stocks should be able to retain their wealth in both USD terms and be able to beat inflation. So it is important to identify select stocks that will outperform the broader index and provide an opportunity for investors to maximize capital gains. Capital Trust Research built its research coverage based on the basis that Sri Lanka's pegged exchange policy was not sustainable, and the currency would depreciate to LKR 230 per US dollar by the end of financial year 2022. But in actual fact, the LKR depreciated even more to close financial year 2022 at LKR 299 rupees per dollar. This fact should lead to select stocks reporting a significant increase in earnings and net asset values. Thus, fair values and intrinsic values of such stocks should increase in an environment where the LKR depreciates. Even though dollar income shares and companies with dollar assets and built up real estate are positively impacted in the current macroeconomic environment, share prices have come down in an irrational manner due to systemic macroeconomic turmoil and forced selling by margin trading providers. In the medium term, it can be expected that astute investors seize the opportunity and re-enter the equity markets by finding mispriced value shares when the market is trading irrationally. If you look at the table listed here, the most liquid stocks in the CSE, such as Expo, LOLC, and BIL, are trading at PERs between 3 to 4 times FY22 forecasted net earnings. When the market bottoms out and trades in a rational manner, it can be expected that these counters trade at higher PERs. This slide captures the increase in both net earnings and total comprehensive income forecasted for financial year 2022 for Expo, LOLC, and BIL due to the impact of the LKR depreciation from 203 rupees a dollar to 299 rupees a dollar. Expo, for instance, is forecasted to report net earnings of 74.9 billion in financial year 2022 due to the depreciation and report total comprehensive income of 108.1 billion rupees. LOLC is forecast to report net earnings of 59 billion in FY22 and report a total comprehensive income of 109.8 billion rupees. BIL is forecasted to report net earnings of 29.7 billion in FY22 and report TCI of 59.8 billion. Expo, LOLC, and BIL provides investors an enormous benefit from LKR depreciation, given its revenue is linked to foreign currency due to its overseas operations. In addition, LOLC and BIL are two listed companies with the large built-up real estate and investment properties portfolios. With the currency depreciating probably over 50% per annum, the replacement cost of built-up real estate increases, thus will benefit from revaluation gains. With Sri Lanka looking to implement significant increases in corporate tax to meet IMF guidelines, it is important to select counters with deferred tax assets and carried forward tax losses. Expo, LOLC, and BIL aren't expected to be impacted by the increase in corporate taxes as they have carried forward tax losses and deferred tax assets at a subsidiary level in the Sri Lankan-based companies. Given the continuous depreciation of the LKR historically, it is important to look at total comprehensive income as it accounts for the earnings generated through recurrent translation gains and revaluation gains for business models that are established to protect earnings against LKR depreciation. Expo, LOLC, and BIL are trading at TCI multiples of 2.71 times, 1.71 times, and 1.46 times respectively. Given that the currency is expected to depreciate further in FY23 until the IMF inflows come in and stabilizes the currency, it is important to forecast potential earnings of companies looking at scenarios such as LKR depreciating to 350 rupees per dollar, 400 rupees a dollar, and 450 rupees per dollar. We haven't finalized our net earnings forecast for LOLC, Expo, and BIL for financial year 23 yet. Thus, for simplicity, we have assumed FY23 earnings will equal FY22 earnings. This translates to a TCI multiple of 2.71 times, 1.71 times, and 1.46 times for Expo, LOLC, and BIL respectively. In addition to Expo, LOLC, and BIL, companies such as MGT, TJL, DIP, and Waterwell, which are companies exposed to USD income, are trading at very attractive PERs of 3.75 times to 8 times FY22 earnings. Given MGT's expansion kicking in the first quarter of financial year 23 and the acquisition of SAT being financed through fixed LKR loans, we expect financial year 23 earnings to pick up and PER to be very attractive on a forward-looking basis. With the increase in interest rates, it is expected that residential construction to ease, thus the demand for building material is expected to decrease. But due to the import ban of tiles, demand exceeds supply by over 30%. Therefore, even if demand decreases by 25%, RCL, Lanka Wall Tile, and Tile will be able to sell 100% of their production. Given the earnings outlook and ability to pass on cost escalations via multiple price increases due to its 70% market share and attractive dividend yields, the current PERs of 3.66 times to 4.22 times FY22 earnings can be deemed extremely attractive. It is expected that RCL, LWL, and Tile be re-rated after the market bottoms out and trades based on fundamentals again in the future. In the medium term, once the forced selling of margin providers is absorbed and the equity market bottoms out and acts in a rational manner, it is expected that select equities outperform the broader index and reach its fair values based on fundamentals. It is therefore advised that investors realign their portfolios to select stocks that will provide protection against currency depreciation, inflation, and increase in taxes. It is advised that investors remain in dollar income-linked stocks such as Expo, LOLC, BIL, DIP, MGT, TJL, and Waterwell. It is advised that investors remain in companies with real estate as well, as replacement costs will be very much higher. Therefore, benefits from revaluation and net asset value increases. For example, companies such as LOLC and BIL. That brings into our presentation, and we'll move on to the Q&A.
Since there are no further questions, I would now like to close the webinar. We want to keep our webinars concise and relevant, but we assure you we will be back soon. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our staff who helped to organize this webinar and for our valued clients for your continuous trust and support in us. Thank you very much. Have a nice day. Thank you, Hasita and the research division for their valuable insights. Now we have with us here Mr. Tushan Wickramasinghe, Chairman CEO of Capital Trust Holdings, and Hasita Liyanage to take up the questions sent in the chat.
I need to show. Sorry, everyone, about that confusion. I just realized that our slide on the building material sector wasn't visible earlier in the presentation. So this is just a snapshot of the earnings and the forward PERs, as we mentioned before. They got attractive given the current sell-off experience in the market. Just moving on to the Q&A, there are a few questions that have come in. Let me just take the questions from Angelo. Angelo has posed a question: what is the projection for the tourism sector with moratorium extensions expected to conclude in June 2022? What is the bearing in the increase of cost of finance and energy costs for tourism? We haven't been bullish on the tourism sector for the last couple of in the recent past because of the sentiment associated with the economic turmoil in Sri Lanka, as well as the Easter tax, and then the COVID related declines in tourism numbers. So we can't really comment on that at the moment. But he has also posed a question on apart from LOLC export bill, can we expect other dollarized counters to perform equally? Specifically, production related export oriented equity holdings such as MGT and TJL. As we mentioned in our slide, uh, dollar linked companies such as MGT, TGL, and whatever all should have positive impacts from the 67.5% depreciation, where their earnings will increase accordingly. So we do see an increase in revenue. And as you correctly mentioned, there will be certain cost escalations in terms of production costs increasing. But the overall benefit in terms of net earnings margins should improve. For example, as we mentioned in the presentation, MGT finances acquisition of South Asian textiles with rupee debt, expecting this significant depreciation. Now, since it has happened, their loan repayments will more than half. It will come down by 67.5% in dollar terms. So there's a massive benefit in interest costs as well as capital repayments in dollar terms for these companies. So that'll be a big benefit. So yes, so dollar linked companies should perform well even with accounting for the increasing costs.
Okay, there is a question. What is your stance on real estate investments such as apartments? Well, for the last 1.5 years, we have been correctly identifying that there will be hyperinflation and dollar depreciation. That has been our focus in more than 29 webinars. So basically, our inflation next month officially would be around 25%, according to what Dr. Nandalal Veerasinghe has indicated. Even though the interest rates would go hand in hand, only passive investors would be happy in getting a zero real return. In other words, in Afghanistan, even if the inflation is 45% and interest rate is 45%, what happens is that the real return is zero. So you don't do a lot of economic activity, or you don't live to make a zero real return. So people must understand that all your efforts are to make a massive positive real return. So coming back to apartments, basically what has happened is because of inflation in the last 2 months, more than 250 apartments in the well-known apartment complexes have got snapped up, and there is hardly anything remaining. Then the quoted companies and very large companies will, with whatever losses, will complete the apartments. However, the smaller developers who are at the start or ending apartment complex will find it difficult to get the building materials because you can't now import, specifically tiles and sanitary ware, etc. While you will not be able to you will not be able to make it a viable project by paying double in terms of foreign exchange. So as a hedge, you should have bought real estate also, what we have told in the last 1.5 years. And if you're not having the necessary amount of money and you want liquidity, you need to go into the companies which have real estate large quantities. The largest is LOLC, then BIL, John Keels, etc. Then there is another question from Zareen Rashid. Would there be positive impact on the market due to easing of margin trading by SEC directive on forced selling? Well, earlier there was mandatory forced selling by margin trading providers at 70%. Now that limit has been increased to 80%, provided there is a letter signed with the investor. Then far as broker credit is concerned, it was earlier 66%, and now that has been increased to 83.3%. And both are up to 31st May, but it most probably will get extended. So there is a relief, and there is a certain amount of forced selling because of that will not come in. At the same time, we must say that in the last 1 week, most of the margin trading providers approached the clients and have obtained additional security. So most of these things are sorted out. There has been a misconception in the last 2 months where people look at all the margin trading accounts and say, okay, this share has this amount of margin trading accounts and this much of selling will come in. It doesn't work that way. Basically, some for convenience, they have margin trading accounts for electronic settlements. Some customary had margins of 10, 15, 20%. So everyone in margin trading accounts, it doesn't mean that they come into forced selling. And at the same time, as I told you all, that most of the forced selling, quite a lot of the cases have been settled. And over the last 2 months, from actually 23rd of January, there has been forced selling going on. Then there is another question with all negative. Then there is another question. There is news that there is problems with IMF funding. Well, Hasita, there was a Reuters.
Yeah, let me just share.
Actually, Honorable Ali Sabri, Finance Minister, has actually gone into many interviews, Bloomberg, Reuters, etc. And Hasita, now there is this is the official press release by Reuters. So
yeah, so I think the basic essence of what was communicated by the IMF is that they are willing to support Sri Lanka at this time on condition that there is restoration of debt sustainability. And as we mentioned in our presentation, CBSL has already taken steps in terms of addressing this, where for one, they actually closed the RFP for the appointment of debt restructuring advisors, and the parties would be selected in the next 2 weeks, and then negotiations will commence with bilateral as well as ISB and other debt other creditors. So that process should enable debt sustainability to some extent. At the same time, the finance minister mentioned there has to be fiscal reforms as well, where the tax collections increase from 8.6% of GDP to 13 to 14% of GDP, which will also enable debt sustainability. So there will be measures taken to address the IMF requirements, and that should enable us to draw down on various facilities available through IMF.
So adding to that, with various information sources from Washington, I could say that there is funding coming. I mean, I can't guarantee this, but these are some of the commonly mentioned information. In 2 weeks from World Bank, $400 million. Then from IMF, within 1 month, $70 million, and thereafter another $378 million through the rapid scheme. Then IMF, ADB, US Treasury will give the balance to make up 4 billion, and that would be by 4 to 5 months time. Then Japan, there are various negotiations in 1 to 2 months. There are various figures told from between 1 to 3 billion swaps. Then from India, 500 million, 2 billion, and further figures. So the real problem is in the next 2 months, which you need to have courage, see even prices coming down, but you need to hold on and go through that period. Then there is another question from Mr. Piris. Will stocks continuously be affected by political turmoil? Well, in our presentation, it was said that there will be most probably a caretaker government, and it can be fast as end of next week. I mean, since it's political, I don't want to go into who is going to be the new prime minister, etc. But there is going to be a compromise, and I think everyone understood the importance of not scuttling the funds which are going to come in, and therefore it did not happen last week. But with the delegation coming back by tomorrow, these political changes can happen. And looking at what happened in the market when 41 MPs went and sat on the opposition side or as independents, then the market went up 6% on the following day. So the market, correctly or wrongly, seems to want some sort of a consensus, a national government, a caretaker government, to go through this difficult period. And also my feeling is that once that happens, these street protests will drastically diminish and give strength to the market. Hasita, can you go back to those events which happened? Okay. Until then, there is so-called saga. So there's questions about the CC directive that we have spoken. Then bill has substantial debt, particularly related because of the sharp interest rate. What would be the impact on bill? So there is another way of looking at interest. Basically, the interest rate is adjusting to the official inflation rate, right? So what happens is, if the official interest rate is, we'll say 20%, the official inflation will be 20, but the asset will be going according to the actual inflation rate, which may be 50%. I hope you all understand that. So I'll repeat it. Basically, the lending rate will be equal to the official inflation rate, so that the real return is 0. But the actual inflation rate may be 50. Now, for built up property, actually it is more than 100%, because you look at the increase in cement, cables, it's very much more than 100% over the last 1 year. So bill has been built on a model over the last 5 years in taking advantage of the possible dollar depreciation and the imminent hyperinflation. So it's not affected, although on paper you see there is a problem. Then So basically what in these slides, what we were trying to say is that, you know, there have been certain effects which have happened. So what we are trying to say in this slide is that when the in January, the 500 million sovereign bond was paid, people suddenly realized, my gosh, they are paying the sovereign bond holders, and there will not be money for people to have the basics. So 8%, market came down 8%. Then people went on selling stocks. So here we say, if you look at the green portion, 16% reduction happened due to these power cuts. But however, monsoon rains will come in, have come in, and the power cuts, which were 13 hours, has come down to only 3 hours. So now people haven't realized that the market has to correct upward also, because the 13 hours have become 3 hours. So this 16% reduction should not be 16%. Maybe you may warrant only a 6% reduction. A 10% increase has to happen. Next slide, please. Then, yeah, then I'm again repeating, because of LPG shortages, a 6% reduction happened. But the minister in charge says in 1 to 2 weeks, distribution will be sorted out and enough stocks are in the country. So when that works out, then should the market move up 6%? Then the next one is, you all remember that Friday, day after the Mirihana incident, what happened is straight away the market closed within 7 minutes, coming down 10% because of the violent protests in Mirihana. But thereafter, we don't have it. So that has corrected. So shouldn't the market move up something of that 10%? Then another 2 days, the opposition parties were trying to get 113 and trying to scare the prime minister. So the market in another 2-3 days came down another 9%. Then there was countrywide protests going on. So people protest and protest and protest. Yes, but what happens if these funds coming and all the reasons for the protests get sorted out? I'm saying if, right, it can happen. Then are sort of believing in a mindset. If they come seats, don't you think that will positively impact on the market, right? So what I'm saying is now the latest sort of shock is the increase in interest rates. Yes, people will go into this fixed income, but by going into fixed income, basically you're trying to equal your real return to zero. But the actual inflation is more than 50%. So progressive people will have to continue in equity to make a large positive real return. Yeah. Then practice of so-called can understand. There has been a stance of producing 20. Yeah, that's not. Okay.
There's a question from Dileepa Vikramasinghe. We have seen big banks going out of business during financial crisis around the world. I have exposure to the banking sector. I'm certainly a fan of the sector. Any views of threats to the big ones in Sri Lanka? Actually, let me draw your attention to some information on the exposures.
So the banking sector in a financial crisis, we have continuously not recommended, and we have left it to those who are recommending to comment on it. But since there's a question, Hasita, can you?
Yeah, so just this is just a basic summary of the exposures to ISBs that the listed, as well as the two where, and as well as multilateral debt and bilateral debt. But SLDBs, the banking sector have requested some relief on that, as the central bank promoted the banking sector to invest in SLDBs. So, but to ensure debt sustainability, it's still unknown whether there will be a haircut on SLDBs as well. If there is a haircut on both SLDBs and ISBs, then obviously the impact on the banking sector is more severe. So just looking at some of the information, so assuming a 25% haircut on SLDBs and ISBs, the total impact can be around 312 billion. So yes, the banking sector will be impacted one way or another with the debt restructuring exercise. But the true extent of it is still unknown until the debt restructuring team finalizes the quantums, etc.
Yeah.
So that is our take on it, but we haven't really quantified the impact on the capital adequacy ratios, etc. From these haircuts, but our initial analysis says that, okay, the banks will still meet its capital adequacy ratio. So there won't be a run on the banks as such. And it won't be a systemic issue.
Over to you, Prashani.
Since there are no further questions, I would now like to close the webinar. We want to keep our webinars concise and relevant, but we assure you we will be back soon. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our staff who helped to organize this webinar, and for our valued clients for your continuous trust and support in us. Thank you very much. Have a nice day.